webinar given by Harts today, and we hope to give you a full insight into what the budget actually held for everybody, and again to be joined by our tax director, Mr. Chris Bentley, who's going to be delivering most of the good-ish or bad-ish news. But first of all, we have to do our usual stuff, which is basically read out a disclaimer. Which basically says the following presentation is produced for general guidance only, and professional advice should always be sought before any transaction is undertaken. Individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of their affiliates for any action taken or any decision made to refrain from action by attendees of this presentation. Okay, that's the small print out of the way. Bear in mind, we've got lots of resources available to you. Follow us on LinkedIn. We are posting Monday to Friday. There's lots of useful information in there. So feel free to follow us on LinkedIn. We're also going to have our own YouTube channel. And go to YouTube, search for Harts Limited, and you'll see over 5 years worth of videos, of webinars, of interviews, and so on. And there's plenty of good information on there as well. And we're also on Spotify on the basis that we've been doing some interviews with people who've seen it, done it, got the t-shirt, and so on. So it's well worth having a look at those interviews with some good business people. Next events, well, we just completed this year, coming to the end of this year's events. We just had our last business club event last year. That will be continuing next year at the Holland Hall Hotel over in Bollington, where we do some networking with lunch and speakers and so on. It's well worth joining us for that. Watch out for the dates and times for next year. They're normally every quarter. So it's well worth joining us for that. We normally get about 50 people to joining us for lunch, and it's a great opportunity to network and meet other businesses. And we will be continuing on with our webinar series for next year. We're putting together the whole series for next year at the moment. If you've got any suggestions of any stuff that you would like to see put on as a webinar, just drop me an email. But again, watch out for the details, the times and dates of those new webinars coming up next time around. And just as a quick reminder, these are all the sort of services that Harts offer. We do offer an awful lot. Some people say, didn't know you do that, which is sometimes very frustrating, but here's just a quick list of all the stuff that we do. If you're interested in any of those services, please feel free to get in touch. An update as well, Making Tax Digital is coming in from April 2026. So make sure that you are ready. This applies to individuals, sole traders, and for landlords who have combined income, and this is turnover, not profit, of £50,000 or more. If you do in 24-25, you are caught by Making Tax Digital. If you want more information, we're just about to release another video. Watch out for that on our YouTube channel, or feel free to get in touch. Companies House, you need to be able to verify yourself as a director or as a person of significant control. If you need any help with that, again, just let me know. We can drop you the link to be able to verify yourself. And of course, we're in the silly season for self-assessment returns. Filing deadline is at the end of January. We don't want to receive your information on the 30th of January. If you've got your information, can you get it into us now? Or if you need a tax return doing and you're not already a client, then please feel free to get in touch and we'll be able to sort you out. Okay, so now we come to the point where on our last webinar, we gave some predictions as well. And okay, yes, I'm not the Chancellor, but I don't think I did too badly when we were looking at some of these. The first one we looked at was VAT registration threshold. We thought might be reduced. It hasn't been. So we got that one not quite right. And the reduction in pension tax-free cash, we didn't get right. She left that as it was. The higher rate of income tax to be increased. Well, we were partly right on that, and there'll be more coming through on that from Chris shortly. Reduce NI on working people and increase the basic rate of income tax. Again, we were partly right. So again, it's a little bit of a victory there. And the dividend tax rate will increase. We got that one spot on. So that is actually happening, and more of that is actually coming. And our outside bet that pension relief will be restricted or cut to basic rate relief. Well, that's actually happened as well. And we will come on to more details of that shortly. So that's enough of our budget predictions and how we got on. I don't know how you got on with what you were predicting, but we hold our hands up here and just say, yeah, we can get it right most of the time, but I'm not the Chancellor. So I'm going to stop sharing that screen and I'm going to start sharing our next one, which is our autumn budget summary. So over to you, Chris.
Thank you very much, Stephen. Just waiting for the slides to pop up.
1 second. There you go.
Thank you very much. So yes, budget last week. But before I dive into that, if you just turn over the slide, please, Stephen. Can I just remind everyone that we politely request that all attendees turn off any AI functionality that might be used to record the presentation, transcribe it, annotate it, take notes, etc. We do that so that everyone can speak and ask questions more openly. And also, if there is something that needs to be edited out afterwards, we can do that before the recording is made available on the Harts YouTube channel. I have seen a couple of AI assistants flash up since Stephen mentioned it previously. So could those who've got them please turn them off? And obviously, Stephen, if you see any pop up, could you remove them from the meeting?
Yep, will do.
Thank you. So the standard disclaimer is that the following presentation is produced for general guidance only, and professional advice should always be sought before any transaction is undertaken. Individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of our affiliates for any action taken or any decision made to refrain from action by attendees of this presentation. So then moving on into what you're actually here to hear about, and that's the budget. Now, I don't know about you, but I definitely had a bit of a sense of deja vu about this budget. And I don't mean the fact we had 3 months of speculation beforehand about what the government may or may not do. Every single rumour possible for taxes going up seemed to come out. But why do I think it was deja vu? Well, we had big tax rises and big increases in government spending. Yes, the excuses given by the government were different this year to last year. There's different rows about who left a black hole, whether anyone was misled, different background to it. But the broad theme of it is, again, increased taxes for increased government spending. Hence my feeling of deja vu. Now, if we just recap on the next slide, as a visual, next slide, Stephen. As a visual takeaway of last year's budget, 2024, businesses and business owners really got the bill for it. It was very much a Halloween house of horrors, delivered on Halloween or the day before, hence the visual imagery. If you think back last year, business owners, special treatments, employers' NIC increase, threshold reduction, massive increases in minimum wage, big restrictions on business property relief and agricultural property relief if you should die while still owning your shares in the business or owning the business. And of course, also the pensions changes to defined contribution pension pots on top of that. If we scroll on to this year, some of us, I think, feared it might be the nightmare before Christmas. I don't think it was quite as bad as that for business owners this year. We still do have big tax rises, but the business owners weren't singled out this time around for special punishment, special treatment. The tax rises have been spread across a much wider population. And for that reason, I thought that the Grinch was perhaps a better visual imagery for this year's budget. What I will say is none of the major changes which were trailed in the run-up to the budget were implemented. Things around capital gains, income tax rate increases, and national insurance reductions reduced. None of that happened. Changes to the scope of VAT or reduction to the VAT exemption threshold. The things that could have made a lot of money that they trailed weren't there. Instead, what we had was a vast array of measures and lots of additional complexity. In other words, our Chancellor's red box was very full of little bits and pieces, which you can say what you want about those bits. We'll talk through some of them now. So starting with personal tax, and that's probably where some of the biggest headlines are. Yes, your rates and allowances are frozen. Personal allowance is still 12,570. The higher rate threshold is still 50,270. The top rate threshold is still 125,140. We've still got a tapering of the personal allowance from 100,000. What we've got though, these were meant to start to change in 2028. They've been frozen for I think 4 or 5 years already. 2028 was only 2 years away. Well, the government needs to find some way to get some more money, but doesn't want to take it off us now, and doesn't want people to realise that they're taking it off us. So they're keeping those allowances frozen now until 2031. That'll be a full 10 years by the time we get there. If you ask me for my predictions going forward, I think I noticed a week or so ago that an MP's salary is about 94,000. So given how political some of the budgets have been recently, and how it would appear that the government's friends and allies seem to have come through a lot of them fairly unscathed, I do wonder whether if MPs' allowances hit 100,000, whether we'll see some movement on that before 2031.
Very cynical, Chris, but yeah, I probably agree with you.
Sorry, I am becoming very cynical, and when we move on to the winners and losers, you perhaps get an idea of why. So the pension's annual allowance of 60,000 is unchanged. Biggest beneficiaries of that are higher earners in the public sector. Student loan repayment thresholds are frozen. Interestingly, on some of the more modern plans, a student graduating and starting work on the minimum wage, increasingly the case for graduates, will actually be making loan repayments if they're working full time on literally a few pence above the minimum wage. So if we turn over to the next page. So income tax rates. So those who are employed, self-employed, or have pensions will continue to pay tax at 20%, 40%, or 45%. Dividend tax rates are increased at the basic and the higher rates from this April coming. So business owners get the tax increase straight away. Interestingly, the top rate on dividends remains at 39.35%. So those who are over 125 grand, there's no increase on that slice in income. I've heard it rumours through the tax commentators that actually the reason that one hasn't been increased, which at first glance seems fairly strange, is that there was pushback from the city who said that people will be put off investing on the London Stock Exchange. Typically, these are highest earners, if that dividend tax rate is increased further. So that's the story I've been given. Whether it's true or not, I don't know, but it's only the basic and higher rates of dividend tax that are going up, not the top rate. So then, in something that makes things actually an awful lot more complicated, the tax rates on property and savings income increased to 22%, 42%, and 47% from the current 20, 40, and 45 from April 2027. The reason that's delayed a year is because the mechanics of doing it and making tax software work to calculate tax at different rates on the property income is complicated. That's why there's a stay of execution for landlords.
So it's landlords being hit yet again in the budget.
Being hit yet again, yes. I was going to say, an interesting the commentary around that is why are the government doing this? Because it's only going to end up with the tenants. We know that, but anyway, it's not for us to speculate on why the government does what it does. If we then move on to the next page, national insurance, this is the easy one. No changes. Employees continue to pay at 8% and then 2% thereafter. Self-employed remain at 6 and 2 thereafter, and there's no changes to employer nick rates or allowances. Now, I know that many of you will have watched the commentary in the run-up to the budget, and there was talk about those rates being cut by 2% and income tax rates being increased by 2% across the board. What we've had is the increase on dividend income, savings income, property income. So landlords, savers, and business owners are hit. There's been no change to employees or the self-employed, including partners in a partnership or LLP. Who's got away with it? Who still pays no tax, no national insurance or anything equivalent to national insurance on their income? The only source where 2% uplift hasn't happened, it's pensions. So that makes pension extraction that much more attractive. Hop over again. So yeah, it would also have been a lot simpler if the government had stuck with the original proposal, and we wouldn't have these multiple tax rates to work out. So what does all of that mean? And this is the bit where you really have to take a step back and think, where's it all going to come out? So most business owners, the vast majority of business owners, draw their income in the form of dividends. You're going to see a tax increase on drawings from April 2026. Landlords, you get your tax increase April 2027. Of course, also making tax digital and increases to interest rates on tax are also coming through. There's no increase on tax on the pensions. So as I mentioned previously, extraction from your limited company of the profits through pensions has become that much more attractive again. The government can make a claim not to have increased taxes on working people because there's no increase to income tax rates on employees or the self-employed. Whether you believe that, given what's happened with the freeze to the personal allowance, is one for you and one for debate in the media. So the winners from the budget, leaving aside the frozen allowances, are most of the employed, the self-employed, and pensioners. Who are the losers? Company owners, landlords, and savers. But I will say in company owners, typically small company owners. Big businesses lose in another way, which I'll come on to later. And then because of all the multiple different tax rates, they're going to have to also introduce some new rules to order your income to make sure that you pay tax at the highest rate possible, rather than being able to pick and choose to get to the lowest rate possible. So another joy buried in the detail of the budget.
So again, we've already got tax law in this country is already running to over 23,000 pages. I can see another couple of thousand being added on here if we're not careful. So much for making tax more simplified. We don't see any semblance of that just at the moment, but we can always live in hope.
We can live in hope, and of course it's all, at the moment, it is all very, very political. If you look at what they went for in the budget and where the money went to, I think it would be hard to avoid a conclusion that the budget was designed with the backbenchers in mind. So profit extraction, which is probably where most of you are most worried about this budget and where it's going to leave you going forward. This is a busy slide, and I'm not going to go through every single number on that. Don't worry at all. But if you look at the rates on dividends between the April 25 and April 26 box, you'll see that the effective rate Now, effective rates include corporation tax, employers' national insurance, income tax, tax on dividends, employee national insurance. You'll see that the rate on dividends effectively goes up 1.5%. It's not 2% due to the corporation tax. What that suggests is it's worth considering whether you should bring forward drawings into the current tax year. The reason I say consider is because you don't want to push yourself into a higher tax bracket needlessly, because doing so would mean that you paid more tax overall. It's not a one-size-fits-all solution to the changes to the budget. It does also really ask the question of, is it preferable to trade through a partnership or an LLP? For those of you who've already got limited companies, it's very difficult to move from a limited company to a partnership or LLP. But if you're setting something up new, going into business for the first time, if you look at the difference between the tax rates for a sole trader or partner and the tax rates on dividends, they're enormous. And also difference on tax rates on pay as you earn, they are enormous. It makes trading through an LLP definitely worth considering in a way that it hasn't been for many years. There was talk at one point that employer national insurance contributions would somehow be put on members of LLPs. That's not happened. The story is that there was pushback in the city from the big law firms, big accountancy firms who threatened to take their members offshore if they did that. Again, whether or not that's true, I don't know, but it's a story that's circulating as to why she didn't go down that route. So if we then, leaving aside partnerships and LLPs, we then think, is it still worth paying yourself as a business owner through dividends? If you look, the rates are now a couple of percent higher for higher rate taxpayers. Why would you pay dividends and pay an overall tax rate, higher tax rate? Should we not just go pay as you earn? In some cases, the answer will be yes, but in a lot of cases, probably not. Again, unfortunately, it's not one size fits all. There are reasons to still continue with your dividends. One of those is that it makes it much easier to split income with a lower earning spouse. Put some of the shares in the husband's name, pay them dividends. They're doing a minimal amount of work in the company, so they can have a small salary, but we can use their allowance with dividends much more easily than we can do with salary. Another reason for dividends is, and this one is a harder concept, is it effectively extends your personal rates and allowances because some of the corporation tax bill is put into the company. I'm not going to try and explain that one on this webinar. If anyone wants me to talk them through it afterwards, I can do so. But what it means is you can take out more at basic rate or at higher rates before tripping over into higher rate of £100,000 and withdraw the personal allowances if you're taking dividends than you can through pay as you earn. In many cases, that will outweigh the increased tax rate on dividends as opposed to pay as you earn. The numbers on the right don't include the dividend allowance. They don't include the employer's national insurance employment allowance. If we start thinking about the latter in particular, it starts pulling you towards pay as you earn in certain circumstances. So let's say you are a company where there are 2 or 3 employees. So you've got the employment allowance of 10,500 of employer NIC, but you're not using it in full. If that's you, it's probably going to be much more tax efficient to increase your salary to maybe 40 or 50,000 rather than the routine 10 or 12,000. pensioners, if someone is over state pension age, they don't pay employee national insurance. Those business owners, again, it's probably worth them switching to a much larger proportion of their income coming through the payroll. There is a cash flow disadvantage, of course, from taking things through PAYE. You pay the tax in real time rather than a few months later through self-assessment. Who are probably best staying on dividends? If you are taking out up to a particular threshold, be that the basic rates, the 100,000 child benefit withdrawal threshold, you can get more out through dividends than you would be if you tried to take the same income through payroll. That's due to the bit I said before about putting some of the tax bill into the company. The other group is those who are very much using dividends as a route to split income with their spouse. That is far easier using dividends than it is through payroll. So I suppose the summary of that is that there isn't a one size fits all. Hopefully I've given a bit of a guide in terms of which business owners it would really be helpful to start thinking about taking more through the payroll. No changes need to be made before April. This isn't something you have to decide next week or even over Christmas. You've got till April to do it. And actually, there's an argument you've got longer than that, depending on when your year ends are. The impact of all the changes, though, is going to be least on the most successful business owners who are already paying at the top rates of tax. Square that one with what the government said they wanted to do in the budget, if you can. But any questions, Stephen?
We haven't got any questions coming through, but if anybody wants to ask any, I know it's complicated, and I can see my 23,000 pages going to quite a few more thousand with all this lot. But if you've got any questions, please feel to stick them in the chat box, and we'll attempt to answer them. But as you can see, it's not something that we can do for every say this is how you should do it going forward for everybody. We can always speak to you individually and see which is the best way for you going forward. It'd be interesting to see how the software houses work on it as well. We'll wait for that information to come through, but certainly it's not straightforward. As you can see, it's just made it that much more complicated.
I think to stop people worrying, I don't think anyone is going to get massively rich or massively poor.
No.
As a consequence of whether they go pay as you earn or dividends. Yes, we would want to move people in the right direction, but I think we will need the software houses to get their offerings out so that we can model properly to actually be able to give people the proper advice. It's something that would be incredibly difficult to do on a spreadsheet.
Yeah.
So changes for businesses as opposed to personal tax, a lot less on this side. For most people anyway. So corporation tax rates remain unchanged, and we still expect them to do so for the remainder of Parliament. The headline rate is 25%, and the 19% remains if the company's profits are less than 50,000, and a tapered rate applies between the two of those. I've just had an AI note taker pop up. Could that be turned off, please?
That's for Louis. Could you turn yours off, please? Thank you.
Those thresholds are split between the number of companies that are associated. So broadly, the number of companies that you have. So VAT registration, that's stayed at 90,000 and deregistration at 88. I've had another one. Zahid, can we turn that off, please?
Thank you.
There are no changes to employer NIC. The rate remains at 15% for earnings over 5,000. However, there are multiple changes to business rates, particularly for the leisure, retail and hospitality sector. We're not experts in business rates, so I can't go into that in detail. But if you are in that sector, it's definitely worth looking into what the changes are and for your particular property and therefore how that might affect you. Definitely the industry bodies representing those industries have realised that the devil is in the detail, and that there are some real nasties, as well as some people who won. Obviously, the government has pointed out who's done well, but there are some real nasties in there. So businesses in that sector, do look into how your business rates will change for your property over the coming years. Minimum wage. I think a lot of people will have breathed a sigh of relief when the minimum wage announcement came out last week. For the last 3 or 4 years, we've had increases in the minimum wage, or living wage as it's known for over 21s, that have been very significantly in excess of inflation. And for particular sectors, hospitality, retail, care sector, that has caused some enormous problems, because wages have had to increase. It's had to flow through to customers, but equally it's caused distortions in that you end up with your supervisors being paid the same as the juniors, because that's the going rate in that sector. So I think a lot of employers who are cost sensitive will be relieved that the government has only gone for a 4.1% increase in the minimum wage from next April. I think we've typically seen pay settlements maybe being in the region of 2, 3, 4%. So it shouldn't cause too much more distortion than where we are at the moment. Perhaps the more problematic bit is for those businesses who take on 18 to 20-year-olds, and to a lesser extent the 16, 17-year-olds. Those businesses have got a bigger cost increase, and it's interesting to see. It will be interesting to see whether businesses will still want to take on those younger employees, who are cheaper to employ, but of course don't come with any knowledge, skills, or experience because of their youth. That was always the reason for a lower rate for younger members of staff. The government has said it wants to phase that out, and it would appear that it's still trying to do that. But sectors who've traditionally given those younger employees their first taste of work are now beginning to push back quite hard, and quite publicly about it. So I don't know where we'll get to, but be careful if you've got people at or around the minimum wage, as you've got those cost increases coming through.
You've also got to be aware of HMRC, who now are conducting quite a lot of national minimum wage visits to make sure you're complying with these regulations. We've had a few inquiries already. We're starting to see those come through. And the threshold for naming and shaming is very, very low. I think it's something like, is it £250? I think something like that.
I think, Stephen, it's about 20 quid.
Yes,
it really is trivial.
It is very, very trivial. So just make sure you've got all your ducks in order for that one.
Okay. So capital gains tax. Lots of people thought the rate was going up again. It didn't. It stayed at 24% for higher and top rate taxpayers. The annual exemption remained at £3,000. Business asset disposal relief, it was announced that it was going from 14% to 18% in April 26 in last year's budget. A lot of people thought that would be increased again. It hasn't been, and there's been no change to lifetime allowance. The nasty on capital gains tax is in relation to employee ownership trusts. Much more niche in terms of those who it affects. But for those who are caught, those who were considering a disposal to an employee ownership trust, it is a huge curved ball, because the effective rate of tax on those disposals has gone from 0 to 12%. And to make it worse, they did it with immediate effect. So I'm not aware amongst our client portfolio of anyone who was in the process of selling to an EOT last week, although we are having discussions with people who plan to do it in the next couple of years. but there will have been some transactions that were probably quite close to completion and have suddenly got a 12% tax bill in there. Whether or not EOTs are viable going forward will be much more subjective, because it will depend on both the amount of cash that can be got out and also whether enough cash can be got out up front to enable the business owner to pay the 12% tax on the disposal, because that will get paid first, whereas typically with an EOT the proceeds come through over a number of years. If anyone wants to talk about EOT specifically, happy to do that separately. So inheritance tax, again, there were lots and lots of rumours about what was in the red box for inheritance tax. There wasn't a huge amount, and actually what we did see wasn't more pain. Yes, the nil rate band remains frozen at 325, the residential nil rate band at 175, and the taper at 2 million till 2031. Interesting, the nil rate band had been at that level since 2009. So perhaps the cynic in you might wonder whether those children, when they die in 80 years' time, it might still be 325,000. I don't know, but not a huge amount to report there. The change on inheritance tax, if you just pop over the slide, Stephen, is in relation to agricultural and business property relief. Those of you who went and listened to this webinar last year or the equivalent will be aware that the government has introduced a 1 million allowance for those reliefs at 100%, with only 50% relief afterwards. What that meant was an effective tax rate of 20%. Often dubbed the farmer tax, but it also applies to owners of limited companies and to other businesses through business property relief. It's proved wildly unpopular in the farming community, and when you think it through, you could see exactly why the farmers are annoyed. The way the tax operated would hit the family farm, but it would still mean that farmland was a tax efficient investment asset. Probably not what was intended. But we are where we are. The change in this year's budget is that the £1 million allowance is now going to be transferable between spouses. So same as the nil rate band, same as the residence nil rate band. And this includes situations where the first spouse dies before April 2026. So it's a welcome relaxation. A husband and wife can now have 2 million at 100% agricultural business property relief rather than 1 million. It does now mean that there's no reason to update a will purely to make use of, or best use of, the £1 million allowances. But because of the change, business owners, if their business is worth more than 2 million, or might be worth more than 2 million in the future, still need to be very, very careful and think about how succession might be managed and the tax liability that would arise should someone die either unexpectedly or because they're of an age where death is much more likely. So we do need to still think about agricultural and business property relief and planning and succession planning, but there is a relaxation, a very welcome relaxation that has happened for some businesses. The other upcoming change on inheritance tax side is that unspent pension pots will still come within the taxable estate from April 2027. The revenue and the pension industry are still trying to get to the bottom of the complexity of how on earth all of that will work. I suspect that will continue to rumble on for some time yet before we get a final settled position. Okay. So, and then we'll go through a whittle stop of some of the other tax changes that were in the red box. The big one, and probably the only one I'm going to really focus on, is the salary sacrifice arrangements. A lot's been said about these in the media, because they do have, this change does have quite wide application. That said, it probably doesn't impact that many people on today's webinar. The most likely impact is in larger companies and their employees, as these pension arrangements are more likely to currently be set up as salary sacrifice. Public sector pensions aren't usually done by salary sacrifice anyway, so public sector workers probably won't see any change. In most small businesses, there aren't salary sacrifice arrangements. The reason for that is the hassle of setting them up often outweighs the benefits, at least in the short term, so people don't go down that route. If you're a large business with 100,000 people on payroll and an HR team who can update all the employment contracts automatically, it's quite easy to save very large amounts of employees' nick through salary sacrifice. That's why it's larger companies particularly who are affected. The £2,000 limit, after which employee and employer Nick will employ to pension contributions from April 2029, that's in there. And what it means is that it's unlikely to impact people whose salary sacrifice arrangements are only for auto-enrolment contributions. The statutory minimum 5% employee and 3% employer on the qualifying earnings. Those individuals shouldn't be affected. Business owners, as things stand, the documents all talk about salary sacrifice. Most business owners are not doing salary sacrifice when they put money into their pension. It should still be possible to make a significant one-off contribution from the business free of national insurance.
And also presumably then other salary sacrifice arrangements such as company cars, we see that quite a bit. Those are unaffected. I think there's a limit on company bikes now as well.
There's only 4 areas where you can still do salary sacrifice. One is pension, and this one's being restricted from April 2029. Interestingly, the government think that they'll make 5 or 6 billion a year from this. So it's a big tax rise, but not one that's likely to hit small business particularly. Perhaps that's why I went for the Grinch rather than The Nightmare Before Christmas. The second one is low emissions company cars. That still exists. That's still possible. The cycle to work scheme, yeah, but it's relatively small, the amount that can come through that. And some historic childcare vouchers are still there, but they were grandfathered now probably 6, 7, 8 years ago. So I think there's relatively few people who are still on those schemes. Okay. So other things for individuals to be aware of. At the moment, if you work from home, you can take a deduction of £312 for the additional costs of working from home. That's going to be stopped from April 2026 unless the expense is actually reimbursed. Business owners probably won't be affected because you're typically reimbursed for that through your loan account. In other words, you get the money, so you're okay. But senior employees who work from home will lose that deduction going forward, unless their employer actually pays them, which most don't. Those of you who've got crypto assets, they're introducing an international reporting framework. What that means is your crypto asset gains and disposals have always been taxable. But going forward, the government will be able to work out whether you've got crypto assets in whatever jurisdiction. They're bringing the reporting's catching up with the modern world and where the exchanges are. So if you've got crypto, we need to know about it, not just in the future, now. Another real nasty that's buried in the detail of the budget is that there are consultations on bringing forward the self-assessment tax payment timetable from 2029. In other words, they want to get the cash in sooner. The cynics amongst us have thought that this is probably the real reason for MTD coming in. It's so they can get the tax in sooner. Put your quarterly payments, put your quarterly submission in, get an income tax bill, pay it now, rather than paying it through the self-assessment system once you actually know how much profits you've got. No idea where the consultations will get to, no idea how they'll make it work, but brace yourself for a double year of tax payments in 2029, or perhaps in 2030, given there's an election due in 2029. There are increases to late payment penalties and interest rates for all self-assessment taxpayers from April 2027. They were already doing that for those who are in MTD. They decided they're going to do it for everyone. What it means is those who get a tax bill that they can't pay in January, stick their head in the sand, don't do anything about it, will be charged an effective interest rate of 18% on it going forward, base plus 18%. The revenue don't take credit cards, so what they're forcing you to do is speak to them, and then you can reduce that rate if you get in touch. People have spoken a lot about the ISA allowance. For under 65s, it will remain at 20,000, but you'll only be able to put £12,000 in cash. We're not financial advisors, but the changes to the tax system, the changes to the tax on interest and on dividends mean that the tax benefit of using your ISA allowance is increased. If you drive an electric or a hybrid car, there's a pay-per-mile tax coming in from 2028. You probably heard about it in the media. The details have still got to be worked on. And then we have the mansion tax, not one that we're going to be advising on, one for the backbenchers, I think, to debate and talk about, not one for us, so I'll move on.
I think I did read regarding the hybrid vehicles that effectively they've been hit with the double whammy because they still buy petrol, so they're still paying for fuel duty, and now they're going to pay the 1.5p a mile for hybrid vehicles. So is that going to affect the sale of hybrid vehicles? Let's wait and see. There's a lot of wait and see in this because a lot of this stuff is coming in later rather than sooner. But that's something else.
Yeah, it is very much uploaded.
One question which has come in is, if staff bonuses are paid directly into pensions, does this count as salary sacrifice?
The expectation, because we haven't seen any legislation at the moment, based on what has been published, is that if the member of staff has choice over whether they get cash or pension contribution, then that will be a salary sacrifice in his court. But if the member of staff has no choice and it will always go to pension, then that's not a salary sacrifice and is not caught.
Yeah, I'll just chip in there, Chris. You've effectively got to forgo the right to the bonus before you've earned it. Otherwise, it will be caught.
Thank you.
That's a helpful way of looking at it, Chris. Thank you very much. I can see what it means is that in large companies, such arrangements will definitely be salary sacrifice and definitely be caught. The business owner won't be foregoing any rights to that because they never had it. Where you get to in smaller businesses will depend on the arrangements, as Chris O'Hara has correctly pointed out. So a few bits for businesses that are sort of in the detail that you might not have been aware of. So businesses looking to raise funding through EIS or VCT, and those looking to put in an EMI scheme. There's good news in that the eligibility for those reliefs has been extended to some larger companies who didn't currently qualify. Also, if you're buying 100% electric cars, purely electric cars, you can still get 100% capital allowances on those vehicles until the 31st of March 27. That was due to expire 31st of March 26. They've only extended it for 1 year. Whether it will get extended any further, I think is doubtful, given the way that electric vehicles are now beginning to be taxed. So if you're looking to buy an EV through the company, probably the next 12 months is to do it. Time to do it.
And it has to be a brand new one. It can't be a second-hand one. So it has to be a new EV, has to be bought, not leased or PCP. And if you want us to check the agreement beforehand, please let us know, because we've seen a few clients get caught by this, where they've been provided with what looks like an HP agreement from the dealer and actually turns out to be a lease agreement for tax. So we're always happy to give you some advice actually before you buy it.
Yeah. So the next one, Section 455 tax, that's the rate you pay on an overdrawn loan account. So it's very long-standing anti-avoidance, stops you taking a loan from your company instead of a dividend. Unsurprising, the tax rate on that is going up 2% from April as well, in line with the rate on dividends. You might have heard people, the media, banging on about 40% first-year allowance. Ignore it. It applies only in very niche circumstances. It's a good political soundbite, but for the owner-managed business, you're probably getting 100% allowances on everything other than cars, subject to the EV point I made before already. So why would you only want 40% if you're getting 100? Concentrate on getting 100. I think that's probably just about it, I think.
That is it. Thank you very much indeed, Chris. Our next webinar series will be launched fairly soon. That's the QR code to our website. What I'd like to do next is just do a quick poll. If you could put in the chat box whether you give the budget a thumbs up, a thumbs down, or can't be bought, or it makes no difference. If you could just type in your message, or we can get kind of a very brief straw poll as to thumbs up, thumbs down, or no difference. If you could start putting your responses into the chat box, that would be great. And then we can do a general poll as to what we've got else here as well. I know it's very much not representative of the whole of the community, but it'd be interesting to see. We've got some coming through now. We've got some big thumbs downs, thumbs not that different, more downwards leaning. Fair enough. Come on, we've got a few more coming through. Very good. I like that one that's come through. We've got some big thumbs down coming through here. Very nonplussed, thank you. Thumbs down. Not much different to down. Okay. I think we've got the general message here, in as much as we have a lot of thumbs down to this budget. Yeah, I would probably tend to agree with you. I don't think it's done much for what the government wanted to do, which was to promote growth. But you know, we're not here as politicians. We're just here as passing on the message, shall we say, and hopefully making sure you're all compliant. So thanks very much indeed for joining us this morning. As this is the last one of the year, going to wish everyone a happy Christmas, and I hope you have a very prosperous new year, and I look forward to seeing you in 2026. I'm going to stop the recording now, but if anybody wants to have a chat with us offline, please feel free to unmute yourself, and we will be online for the next few minutes or so. But in the meantime, thank you very much indeed, and we'll see you next year.
Thank you.